In this video, we'll be going over the all-important lesson of M&A deal structuring. Now, mergers and acquisitions deal structuring from a buy-side perspective is so important because it could be the difference between mitigating risk and having huge risk. It can be the difference between paying a lot of money for a business acquisition up front and paying a little money acquisition up front and paying over time from the cash flows of the business. Every single deal that you do is a negotiation with a seller. So everyone is going to be different. There's so many different things which are important to different sellers, and as long as you can understand what's important to them, then that will have a different structure that you will bring to that deal. However, there are a few principles that we're going to be going over in this video. So let's get straight into it. The first thing is paying for a deal is divided into two parts. It's divided into cash on completion. Cash on completion. So that's part number one, right? And most of the time there's cash on completion, like 95% of the time there's cash on completion. 5% of the time there's no cash on completion. And the next part is the deferred element. So deferred element. So when we're looking at transactions in the small business space and the lower and mid-market, there's always going to be deferred element. It's when you get to mid-market and above, that's when maybe there's cash on completion and limited deferred element. Now, personally, I've done one deal in which I paid complete cash on completion, and it was the biggest mistake I've ever made in my life in terms of I'm never going to do it again. Even if I just need to hold back 10% for a deferred element or deferred consideration, I'm always going to do that. And there's many reasons for that, which we'll be going through in this video. But there's two parts to a deal, right? So the first is cash on completion and the second is deferred element. So very easy to understand. If you can lower the cash on completion amount and increase the deferred element amount, then what it does for you as a business buyer is that it lowers your risk. So it lowers your risk. Now, of course, every single business seller wants 100% cash completion, right? They're selling their business. Well, when I say every single business seller, most business sellers want cash on completion. Why are you doing all of this? You're doing this to make more money for yourself, right? And the more money you have right now, the better off you're going to be. So business sellers, they want 100% cash on completion, where business buyers, they want 100% deferred element, right? So now we have to meet in the middle somewhere and find out where do we get to in that negotiation and that process. But this is the key thing that you need to understand. The more you can have in terms of deferred element, that lowers your risk. And the higher amount that you pay cash on completion, that increases your risk. So Warren Buffett, he says this in his annual meetings. He says, you know, we take a big risk as business buyers because what we do is that we hand over a large sum of money to these business sellers, business people, and then they give us some stock certificates, and we hope that the business is going to continue to trade at the same level or even better than it was doing in the previously. Yeah, so that's what we're hoping for. And as long as you do your due diligence properly and you are able to sniff out, you know, things that people are hiding, then you should be okay. You should be buying a good business for yourself. But if for some reason something goes wrong during the due diligence process and you're unable to find something which is going to hinder the business moving forward, then you've just increased your risk and possibly done a bad deal. But we want to avoid that as much as possible. So of course, one of the ways that we can do that is to increase the amount of deferred consideration that there is. Now, another thing with regards to cash on completion and deferred element. If, for example, there's a business for sale for, 2.5 million, or that's what the seller wants. That's what they want in terms of 100% cash on completion. And you valued the business, for example, at the same amount. Let's say you valued the business at 2.5 million. So they want 2.5 million and you've actually valued the business that's what it's actually worth to you as a business buyer moving forward. It's worth 2.5 million. But if they insist, no, I want 100% cash on completion, Jason, right, you know what? If you want 100% cash on completion, I will give you, for taking the risk, for assuming the risk of giving you 100% of the cash on day one, I'm going to pay you, for example, 1.5 1.75 million or 2 million, it doesn't matter, whatever the case is, just for illustration purposes. What you're going to do is that you're going to knock off 750,000 for assuming risk. Because when you're buying a business, you're assuming risk. So you're going to pay, the seller is going to pay for that risk. The seller is paying for that risk. They're getting 1.75 million on day one. That's not a small chunk of change. That's a decent amount of money. You can pay for that. You can pay for that risk as a seller. I'm not going to pay for that risk as a buyer. Now, if for example you don't mind, the seller is insistent on, oh no, I'm only going to let this business go at 2.5 million, then that's fine. All right, no problem at all. What I will do is that I'll give you, for argument's sake, 1.5 million on cash on completion, and I'll pay you 1 million over the next 5 years. 200,000 a year. So you want 2.5 million, no problem. I'll give you 2.5 million, but you're going to get 1.5 million cash on completion, and you're going to get 1 million over 5 years, paid 200,000 a year. I'm paying for the risk, but we're sharing a little bit of the risk here. We're sharing a bit of the risk here. Now, we'll go over in this video as how this can be structured and the different ways that it can be structured. But this is what you need to understand. The higher the cash on completion, the more risk to you. The lower the cash on completion, the less risk to you. The higher deferred element, the lower risk to you. The lower deferred element, there's more risk to you. And if the seller is insistent on their prices, then they have to pay for risk. They have to pay for risk by accepting a lower price. Okay? And that's up to them whether they want to accept it or not. Now, of course, if you're in the small business space, really, there are not that many buyers out there. Okay, there's not that many buyers out there. And even at the lower end of the lower mid-market, there's not that many buyers out there. So if you're in their industry and you're buying acquisitions and you're buying businesses in that industry, really, you're one of the only choices. Yeah, so they have to go with you. Otherwise, who are they going to sell to? Who's going to go out and buy their business? If they're willing to wait, that's different. Because they can wait for 10 years. And then someone might come along and snap up their business. But if they're motivated, remember, you should only ever deal with motivated sellers, then you're their only choice. And then, you're dictating the terms in that case. Right, so let's move on to some of the deal structures that are used. The first one is easy to understand, 100% cash on completion. Okay, 100% cash on completion. There is no conversation about this as to what is this. Everyone understands that it's literally like going to the shop and buying milk, right? That's the price, you pay it, that's done. Now with businesses, however, like I said, you can lower the amount that you pay cash on completion. So for example, if they want 2.5 million, like in the last example, they have to pay for the risk that you're assuming, and you can say, no, I'm going to give you 1.75 million or something like that. So number one is cash on completion. Number two, which is the most common, is part payment upfront. Okay, so part payment on completion and part payment deferred. Now, deferred. Now, when you're paying part payment on completion, there's a question of how much you're going to pay on completion and how much is going to be deferred. And we're going to talk about that, but the first thing you need to understand with regards to the deferred element, there's two types of deferred consideration. The first one, I'm going to put this as A, is actual what's called deferred consideration. And I'll explain what it means in a second. Consideration. And the second one, B, is earnout. Right, so deferred payments are divided into two types. The first one is deferred consideration, and the second one is earnout. So what's the difference between deferred consideration and earnout? Deferred consideration is when there is no target, or there's nothing attached to the payment of that deferred consideration, which means that there's no conditions. That's what it is. There's no conditions attached to the deferred consideration. So in the case where you're paying 1 million over 5 years, so if you're paying 1 million over 5 years, that's you basically just do 1 million divided by 5, right? and then you get to your answer, which is 200,000. So it's really easy to work that out. Now, regardless of what happens in the business, the seller is going to get 200,000, and this can be worked out. It doesn't matter. You can pay it monthly, you can pay it quarterly, you can pay it half yearly, you can pay it annually on the anniversary of completion. You can do whatever you want, right? You can make them wait. You can say, look, I'm not going to pay you anything in year one, right? Why? Because I'm giving you 1.5 million on cash on completion. You can wait 2 years, right? And in the second anniversary, I'll give you 400,000. Or you can say the second anniversary, and by the way, this is how I do it, is that I say that the closer time to completion, you're going to get a smaller deferred element. And the further away from completion, you'll get a higher deferred consideration. Now, what does that mean? So let's take the example of 1 million over 5 years. In fact, we'll make it a little bit easier to understand. We'll say 1 million over 4 years. Okay, 1 million over 4 years. So what that means is that year one, you will get 200k. Year two, you get 200k. Year three, you get 200k. So the total so far is 600,000, right? And then year four, you'll get 400k. Year four, you get 400k. So that totals up now. We've got 2, 4, 6 plus 400,000. That's 1 million, right? So I want you to push out the larger amount as much as possible. And there's many reasons why you would do that. For example, I'm sure in 3 years' time you'll do multiple more acquisitions. You'll have time to grow the business and increase debt service cover ratio. You're going to make the business better, make more efficient savings, right? So you'll have more money in the bank to be able to pay a larger amount when it comes down to the end. Yes? So that's how you can do it. Or let's say, for example, if you're doing it over 5 years, you can be like, no problem at all. What I'll do is I'll give you 150 and then 150, so that's 300, right? And then I'll give you 200, yeah, so that's exactly what it is. I'll give you 200, so that's 300, 500. Then I'll give you 200 again, right? And then I'll give you 300 at the end. Because don't forget, when you're doing acquisitions, the riskiest time is immediately after the acquisition. So the longer that you own a business, the risk sort of goes down. The reason why is because if, for example, there are going to be problems with an acquisition, it normally happens in the initial time after you've acquired the business. Now, obviously, if you've got a solid, robust integration process like what we do and we teach our people, is that your integration process needs to be so good that you're not going to have any problems, or you're going to minimize problems at the very least. But as time goes on, let's say, for example, in year one you have problems with the business and it takes you a year to fix it. By year two it's fixed, right? It'll be done quicker, but the worst case scenario, by year two it's fixed. Now, any problems that you might have had, remember, you're only paying 150 and 150 in year one and year two. So your risk is mitigated because you're paying a small amount of deferred consideration. And then the business builds up again and again and again. And then that way, the business is growing, and then you've got more money to pay the last payments, which are higher amounts. So that's about stretching out as long as possible the risk. And I'm just giving 5 years. If you can stretch out 7, 8, 9, 10 years, then that is also better because you're spreading the risk as much as possible. And by the way, there's seller types. There's types of sellers who would be willing to accept a longer deferred consideration element. And when I say deferred consideration, I'm using this interchangeably, both deferred consideration and earn-out. So they're willing to accept longer payout periods, but you have to understand what their goals are. You have to say, okay, what is your goal with this business sale? What are you trying to achieve? If, for example, and I'll tell you right now, if it's retirement and they're not extremely old, like if they're not 80 years old, right, and they're saying, right, it's retirement and they're 60 years old, offer them 10 years on an earn-out or deferred consideration basis. Why? Because look, I'm giving you a check on day one. That's a nice little windfall for you to say, right, no problem, goodbye to the business. And then each year I'll give you a small amount, and that is going to be like your second retirement pot. So you got your pension, which is coming from the government, you've got your pension, which is coming from your workplace pension that you've been paying into over the years, and then you become their third pension. You become the third pension, right? So they get paid another drip from somewhere else. And that's advantageous from a tax perspective as well. Because what in the UK anyway, HMRC does is that they will tax you on the amount that you're getting over time. Now the funny thing is, actually, I was speaking to a business seller who we bought their business. Even though they had a deferred schedule of 4 years, they paid 100% tax in the first year. No, they paid it, whatever it is. And I said, look, you could have stretched it out. You should have spoken to a better accountant. But anyway, that's a different story. So that's deferred consideration. It doesn't matter what happened to business. Now, this is a little bit more risky for you as a business buyer. Why? Because if the business tanks or something happens to the business, then you still have to pay that amount. Basically, when you've got deferred consideration, in the legal documents, it's classified as a loan. The seller's basically loaning you, what's the amount here? £1 million. Right? So the seller's giving you a loan of £1 million and now you have to pay it. Now another thing which is really important is that never accept, there's a lot of people, they talk about paying interest on deferred consideration. I don't pay any interest on any deferred consideration. It's, look, this is what we're paying. This is a set amount. That's what you're going to get. If you start adding interest rates and so on, it starts getting messy. And, you don't know what, you know what's going on, but you end up paying more for no reason. Now, for whatever reason, if you really badly want to do a deal, and you're okay with paying an interest rate, then you can pay it. But there's no reason why you need to. We've never had to pay. Now, actually saying that, there's been 2 business sellers who basically got into, okay, how much interest you're going to pay on the amount, and we said, look, we're not interested. We're not interested in paying any interest rates, so therefore, you either accept this amount, or we kill the deal right here. And we killed the deal both of the times. So we said, no problem at all. And one of them was a really good business. The other one was still okay, I don't mind if that went. But one of them was actually a really good business. And it had strong management team, had been running for 8-9 years. It was doing strong cash flows, growing year on year, right? So literally the owner was a true owner investor in that case. And, because he was too fussy about his interest rates, we said, you know what, thank you very much. Move on to the next deal for us and best of luck with your business sale. So that is deferred consideration, where it's essentially guaranteed payments to the seller over time. Now earnouts, earnouts is really good because earnouts can potentially allow the seller to make more money. In fact, before we get into that, let's get into this. Now, when you are speaking to business sellers, they give you a forecast, right, of what's going to be achieved next year, what's going to be achieved the year after, so on. Now, what happens in the forecast? Every single time without fail, next year is going to be their best year ever. The following year is going to be the best year, even better than that. So they've had 10 crap years, not crap years, but let's say, for example, they have 10 years at, 1 million a year in revenue or 5 million a year in revenue, but for some reason, next year is going to be 10 million in revenue. They've never had a 10 million year revenue year before, ever, right? But for some reason, next year is going to be 10 million. So in that case, using an earnout is the best option. Because what you're saying to them, say, right, let's just use this example. So it's a 5 million a year revenue business, right? And they say, right, it's going to be 10 million next year, and it's going to be, 12 million the year after or something. You basically say, no problem at all. You're super confident, right? So obviously you're negotiating down. You say, look, you've had 5 million years for the last 10 years, right? Or approximately that amount. Why is this business going to go to 10 million? I don't believe it's going to go to 10 million. He's going to say, yeah, it's going to go to 10 million, and they're going to give you the business plan. All right, they're going to say, we've done this, and this person's doing that, and so on and so on and so on. And they're going to say all of these things to make it look, nice and rosy and shiny to you. And then they're going to convince you, or they're going to try to convince you with this 10 million plan. So you say to them, no problem, that's fine. We'll accept that it's 10 million, but then we're going to do an earn-out schedule, which means that if the business, for example, only does 5 million next year, then you're going to get paid nothing. You're not going to get anything in terms of earn-out. However, if what you're saying is true, and everything that you've done is, everything that you've implemented is going to take this to 10 million, we will pay you a increased earnout amount based on that. So what they're trying to do, why they're saying it's going to 10 million, because they're trying to inflate the price of the business, yes? So let's say, for example, the valuation is 5 million, say it's 500,000 in profit. So let's say, for argument's sake, it's a 2 million valuation. Okay, it's a 2 million valuation. And what they're trying to do is that they're trying to give it a 5 million valuation. Right? So there's a gap of 3 million here. There's a gap of 3 million. So say no problem at all. If it does go to 10 million, and what you're saying is a 5 million valuation based on next year, by the way, you're never paying. Well, okay, we'll get into that in a minute. So it's a 5 million year, no problem, that's fine. Next year I'll give you 2 million if we hit the target of 10 million. Because all of the things that you've implemented, and you've given me this long business plan and this forecast, I'll give you an additional 2 million on top of the 2. Let's say we're paying 2 million cash on completion, which obviously you're not going to do. But let's say I will give you another 2 million on top of that, 4 million. And then of course you said that the following year is going to be doing 12 million, right? With a profit of 1.5 million or something. We'll give you another, let's say it's 500,000 over the next 4 years, for example, right? Which will take it to another 2. Was it 2, 4? 5, no, it's not 500,000 over the next 2 years. So we'll give you another 500,000 over the next 2 years, which will take it to your 5 million valuation. So what you're doing is that you're calling the seller out on their business plan, on their forecast. And if you don't achieve it, then you get nothing. Because in this instance, what we're saying, we're paying 100% cash on completion of the 2 million of the valuation that we've put on it. You get nothing. If it doesn't hit the 12 million, you get nothing. Okay? Now what you see is that almost 100% of the time, the seller is going to roll back. They're going to say, oh, you know what? Maybe next year it's going to do 6 million. Not 10. Yeah? Realistic. It's going to be realistic. And then that way, the valuation becomes a lot more favorable for you. So earnouts is a really, really good way to call out on sellers' plans to have the best year ever next year. But by the way, you can use earnouts, even if they're not inflating their business, you can use earnouts in the same way as deferred consideration. So we'll use the same deferred consideration amount of 1 million over 5 years. 1 million over 5 years, 200k a year, almost, or 200k. So we say no problem at all. If the business does, we'll just say it's 5 million business. So if the business does 5.5 million next year in sales, then, and by the way, there's so many ways that you can measure the earnout. However, the best way to avoid confusion and so on, right, is just to peg it against revenue. So you say if next year does 5.5 million, then we'll pay you 200k. If the following year does 1 million, then we'll pay you another 200k. And if the following year does 6.7 million, then we'll pay you another 200k. Right? So what you're doing is that you're pegging it against targets that the business is going to hit. So if it goes to the 5.5, if it goes to the 6.1, if it goes to the 6.7, based on everything that is normally happening in the business, then it'll achieve it. And also you can roll it as well, which means that, let's say for example, it didn't hit 5.5 million 200k, 5.5 million year one after the business sale. Let's say for example, it hit 5.3 million, but then the following year, so that's a 200,000 dip, right? Based on the target, it's supposed to be 5.5 million. That's the target amount for them to achieve the 200,000. But if in year two it achieves 6.3 million, which is another 2,000 on that target, or 200,000 on the target, then they get the 400k. They didn't get paid that in the first year because they didn't hit target. It was 200,000 down, right? But here they not only hit their year two target, but they done an additional 200,000 on top of year two target, which actually makes them meet year one target as well. So then you can pay them 400k. Right? Now obviously you need to do cash planning based on that, because what you're essentially doing is that you're rolling the earnout amount across. But it is a way in which you can get deals done, because of course if you say to a business seller, if it doesn't hit target in year one, you're not going to get the 200k, you're going to lose it completely. You have to react to see what they're going to do with the deal. Are they going to continue or not? And by the way, it's up to you. You don't have to buy a business. Or you don't have to buy that business, right? There's plenty more fish in the sea. You can say, right, no problem at all. If it doesn't hit the target and you don't get paid anything, you're not happy with that, then no problem at all. You can keep the business and I'll go somewhere else. I want to look for another business. You don't have to buy that business. Never be super motivated to buy a particular business, right? Just be motivated to the pathway of doing acquisitions. It doesn't matter about the particular acquisition. It matters that you continuously do acquisitions or strive to do acquisitions over a long period of time. And again, it depends on what your goals are. I talk about Introduction to M&A Strategy Masterclass. That's another video on this channel. Go and check that out where I talk about Empire and Exit. And you can check that out there. Anyway, so that's a bit on deferred consideration and earnout. Now, talking about how much do you pay on day one and how much do you pay over time. And of course, this is a choice, right? It's down to negotiation. When I say choice, it's down to negotiation. It's your choice how much you want to offer, and then there's going to be some negotiation back and forth on how much they're willing to accept. Now, there's no hard and fast rule. You can pay 10% up front or you can pay 90% up front. There is no hard and fast rule here. What you have to determine, what you have to try and get from the seller is that what are they going to be happy with up front? If they're okay with taking 10% up front, that's fine. And by the way, it happens all the time. Yeah. So in actual fact, you got a motivated seller because that's the only one that you're going to deal with, right? Let's say, for example, you offered them 50% up front. Done due diligence, all the rest of it. And for whatever reason, let's say you even had an investor who pledged the 50% up front. They pledge, $500,000, $1 million, 2 million, whatever it is, the 50% amount. And then all of a sudden they pull out. Now you have to go to the seller and say, you know what, I had this. I showed you the offer in principle, right? The offer in principle of investment. I showed that to you. We had it in writing, but the guy pulled out. So what can I do? You have to wait. I have to go and raise the finance from somewhere else. And by the way, that's a clue. You try to raise finance from multiple people, that if one of them pulls out, you've got a backup plan, right? So some sellers are going to be like, you know what, no problem at all. I'll do more of a deferred amount because they're motivated. They've spent money on solicitors. They spent money on accountants. They're already dreaming about retirement or whatever it is that they want to do. They said, no problem, you know what, I'll accept 30% on upfront or 25% upfront. Whatever it is, it doesn't matter. You can negotiate. Look, a business doesn't have a set deal structure. It doesn't have a set price. Nothing. It's all down to negotiation when it comes down to business. And then, there we go. You got a smaller amount up front. Yeah. So, it is all down to negotiation of what they will accept and what they don't. Now, what do I know from experience? From experience, look, if someone's got a profitable business, which is a good business, it's a valuable business, it meets the value acquisition criteria, it meets your deal specification, you can see the value it can bring to your business, and the value that it can bring to your life in income, then, and the seller knows that because they've had a and by the way, they can see that post-acquisition is going to give you a lot of money, then they know that their business is valuable. So in reality, what I see is that at least 50% is paid up front. 50% up front. This is the norm. Right? If you have 10 sellers, 4 of them will accept this 50% up front. And that goes to 50% to 70%. Now, there's a reason that I only go to 70% and I advise only to go up to 70% in most cases. And the simple reason for that is that both investors and lenders want you to put some money in. Right? They want you to put some money in. And the best way that I've come around or got around doing it is that I get a seller finance amount of 30%. Okay, but I also get investor money of 30% as well. So, for example, there's one investor, they're willing, or there's, let's say there's 3 investors, they're willing to pay 70% up front. Okay, and then you, meaning your business, has got enough to pay the 30% in retained earnings. So then you got that cash which you're sitting on there, and you use that as capital, and you get a seller finance amount of the same amount, yes, of the 30%. So that takes 70% up front. You got 100% of the cash there because you got 70% which you're going to give to the seller on day one. You got that from investors. You've got retained capital sitting there. If everything went wrong and the business couldn't pay the seller finance, the 30% seller finance amount, the business that you're buying, you've got the retained capital there to pay the year 1 payment or to pay the year 2 payment of the deferred element. So that's why I like maximum 70%. But like I said, if for example there was a fantastic business that has some sort of market positioning in which I really want, by the way, I'd never really want something like that, not anymore anyway, then I, pay 90% up front. Pay 90% up front and have a 10% holdback. Yeah, 10% holdback meaning deferred element. But like I said, 50 to 70% is the normal amount, which means that the deferred consideration, whether it's through a deferred consideration or an earnout, is going to be either 50%, it's going to be 40%, or it's going to be 30%. I don't normally go less than that. So that's that. Now, obviously, if you're buying a mid-market business, there's a lot of competitors out there to buy those kinds of businesses. You're competing with strategics, you're competing with private equity, right? You're competing with high net worth individuals who have got a lot of money, who's dry powder just sitting there, and then they need to deploy it. Because if you're a high net worth individual, let's say for example you've got 20 million in the bank and it's just sitting there doing nothing. So you're gonna be like, you know what, let me put this to use. Let me spend 15 million on this acquisition and make a good return on it. Because I'm not making anything right now at all from the bank, or very little. So these high net worth individuals, they can just write checks. They can write big checks. And that's what you need to be wary of in mid-market, that maybe you do need to pay a very high amount on completion. Now, there's things that you can do to convince the seller that they should sell you the business and not sell it to a high net worth investor or not to sell it to a private equity. They may be looking for private equity, so good luck to them. But if they're not, then you can wow them with other things, which I've covered in other videos, and get the deal done in that way. So I'm going to rub this out. First way is 100% cash completion, very easy to understand. Second way is part payment on completion, whether it's 10%, 50%, 70% up front, and part payment deferred. Deferred is into deferred consideration, where it's a set payment every single year, or whatever it is. And earnout is based on the business hitting targets. And remember, if the seller says they're going to have the best year next year ever, then you're going to use the earnout, not the deferred consideration in that instance, because they're saying that the business is going to do something which is not currently doing. They were the most common ways of getting a deal done, but there's other ways as well. So, for example, we have to get a little bit into valuation here. If there's a freehold business for sale, what does that mean? That means that there's a property, yeah, and a business for sale altogether. So what does that mean? That means, let's say for example, there's a distribution business. That distribution business is in a warehouse, and that warehouse, let's say for example, the valuation of that warehouse is 6 million. Okay, the valuation of the warehouse is 6 million, and let's say the valuation of the business is 4 million. Right? So now the total price of this freehold business is 10 million. Yeah, 6 million being derived from the property and 4 million being derived from the business. Now, what do you do in that instance? What you can do is that you can go to a property investor. You can go to a REIT, a real estate trust, investment trust. You can go to private investors who are buying commercial property. Pension funds are buying commercial property all the time. Yes, because there's some, especially in the UK anyway, there's some tax benefits to that. So what you can go to a REIT. Let's say you end up going to a REIT, a real estate investment trust, or and you say, you go and buy this property for 6 million, and then I'm going to buy the business, and then you're going to have a lease agreement with the REIT. Yeah, you're going to have a lease agreement with the REIT. So they own the asset of the property, and then they have a lease agreement, for example, for the next 15 or 20 years, let's say 20 years, and they're going to get, I don't know, what's going to be the rental yield on that? Let's say it's 5%. So they're going to get 300,000 a year on the lease agreement. So you got that lease agreement at 300k with the REIT. And of course you have to factor that into the cash flow of the business or what's going to happen in the future. Generally speaking, it's really important that you understand this. Most business sellers, or not most, some business sellers don't pay in rent to themselves. Most business sellers pay a rent to themselves, but it's normally a lower amount. Yeah, normally a lower amount. In fact, I was speaking to a business owner, I think it was yesterday or the day before, I can't remember, whenever it was. He has a property in which the market rent of the business is 60,000 per year, but he was paying himself 48,000 per year. So when I was doing the adjustment of the cash flow, I had to subtract 12,000 from the profits of the business, because he said that if I give you this lease on the property, then I'm going to charge you 60,000, not the 48,000 that I've been paying myself. So I said, no problem at all. We're just going to subtract that from the profitability that you're showing me right now, because that has to come from somewhere. Yeah. So as long as you're taking that into consideration, then you've got this there. Now, what happens to the business? Because now what's happened is that the business owner who's selling their business, their freehold business, for 10 million, has just got 6 million from the property sale. They got 6 million from the property sale. You can be as creative as you want with this 4 million now. So you can say, no problem at all. I will pay you 1 million a year for the next 4 years. I will pay you 500,000 a year for the next 8 years. I will pay you, 250,000 a year for the next 16 years. Whatever it is, you get the point. So they've got 6 million now on day one, cash on. Look, they don't care, or they shouldn't care where they're getting the money from. They're getting the money, 6 million on day one. And then 4 million they're getting paid over time, but 4 years, 5 years, 6 years, 8 years, 10 years, 25 years, it doesn't matter. It's whatever you can negotiate. Now sometimes they say, no, I'm not going to finance the entire 4 million. I'm not going to finance the entire 4 million. You still have to pay me 2 million up front. Okay, 2 million up front, and you can pay me 2 million over the next, 6 years or something, yeah? So now all you need to do is that you need to find funding of 2 million from the profits of the business. When I say from the profits of the business, you take the profits of the business, you show it to investors, you show it to lenders, and you say that, right, how much can we get from this? You would already know. By the way, you do all the calculations in your head, maximum with the calculator, right? You don't need Excel, yeah? If you need Excel, it's too complicated, don't do the deal. And then you just get the money, and then you pay for the business, and majority of that, or half of that in this case, is seller finance. Look, in this case what's happened, they've got 6 million from the property, 50% cash on completion, 50% of deferred element, or you could do whatever. So it's on the previous part up front and part over time. Now, so that's called the property strategy. And by the way, there are so many strategies. Yeah, so that's the property strategy of deal structuring. There's so many strategies that you can use. I'm just trying to think or give you the main principles in this video. Of course, every deal can be created in a different way. It all depends. You got rollovers, you got shares that you can give. You've got, let's talk about this one. This is a good one, because this works normally with small businesses and micro businesses, the one that I'm going to talk about now. Right, let's do this last strategy, which is normally used with small businesses and micro businesses. It's seldom that you will find this with any medium-sized business. So there's something called a director's loan. A director's loan. So this is where the seller has been loaning themselves as an individual. Sorry, this is where a director, a business owner, has been loaning themselves, has been borrowing from the business. They've been borrowing from the business. Now this normally happens in one of two ways. currently in the UK, it's tax-free to borrow from your business. It's not a taxable event. So some people do that instead of taking, large dividends and large wages and so on and so on. So if there's a large director's loan account in the business, let's say, for example, the director's loan amount is, because we're talking about small businesses here, right? So let's say the director's loan amount is 400,000. And let's say they've got outstanding supply bills, taxation, all the rest of it, right? Their creditors, the people that they need to pay, the suppliers, the total amount is, for example, so that's 400k. The total amount is, I'm just going to make a figure up here. Let's say it's 250,000. So now what you see is that the seller has an outstanding bill with particular parties of 650,000. Most people are asset rich and cash poor. Yeah, so most people are asset rich and cash poor. So if they've got this 650,000 that they need to somehow pay back to the business 400,000 and pay their supplies and pay the taxman, IRS or whatever it is, for example, 250,000, they haven't got that money. They have to go and borrow some money or something like that from somewhere else to be able to do that. So they're coming up to, for example, let's say they're sick, they're ill. They can't run their business. Not that they don't want to. They're forced into a position that they can't run their business anymore. Well, you turn around and say, no problem at all. I'll give you 650,000. Okay, 650,000. That's the director's loan account paid off. That's your creditors paid off. So basically, the business becomes into a zero. Well, it's actually basically balances. Let's call it a net asset position of £1, for example. So the business is not insolvent, it's a solvent business, just about. And you've solved the seller's problems by paying 650,000. And let's say, for argument's sake, that business is doing 300k in profit. I don't know why I always come to this 300k number when we're giving examples, right? But 300k in profit, you just paid slightly more, it's like a 2.1 times multiple, whatever it works out to be. 2.3 times multiple. You've paid a really good multiple for that business because the seller's distressed. They say, where am I as an individual, Mr. Business Owner, Mrs. Business Owner, where am I going to get this 400,000 to pay that? Where am I going to get this 250,000? Other than, I can pay the 250 from the profits, that's not a problem. But where am I going to get the 400,000 from? That's the problem. I've been taking this and I've not been managing my money properly, so I've got this outstanding amount. What am I going to do? Even if they write that off, by the way, especially in the UK, I'm not sure exactly about everywhere else, they've got corporation tax to pay on that. So currently they'll be charged at least 20% corporation tax. 80 grand. At least 80 grand they have to pay, even if they write that director's loan off. Which they can do, by the way. Now HMRC are going to be like, oh, why did you write that? If the business became insolvent and they had to liquidate the business, then HMRC would come after the director for 80,000. They say, we want our tax. HMRC and IRS are the biggest reason why businesses go bust, because they're preferred creditor. So you come in and you solve that problem for them. So you've paid technically a 2-point-something multiple for it, a really good deal. You solve their problem, they're on their way, and you've got this business. So that's that. Now, I'm going to talk about this lastly, because I don't really teach this, although I've done these deals myself, 100% seller finance. 100% seller finance, whether it's through deferred, because now you should know what deferred consideration is, whether it's deferred or, why do I keep putting double F here for some reason, deferred or earnout, it doesn't matter. You have to be in the right place at the right time and find the right seller. That's what you need to do. Now, if you notice, I haven't actually talked about where you get the 50% from, or the 70% up front from, or the 100% up front from. Well, I have kind of. You get it from investors and you get it from lenders. So 100% seller finance is where the seller is funding 100% of the deal. If you can only do a 100% seller finance deal, you're probably going to wait a long time. Now, I have heard of people that got very lucky and they managed to get the seller to do a 100% seller finance deal on their first deal. And that set them up for life. And congratulations to them. They're in the right place at the right time and they found the right seller. But the chances of you doing that is like 1 in 1,000. And I can guarantee you that if you're in the position that you can only do a 100% seller finance deal, you're not even making 1,000 phone calls, or sending 1,000 emails, or sending 1,000 letters, or talking to 1,000 people. I can guarantee you you're not doing that. Because the reason why you're in the position that you can only do a 100% seller finance deal is because of lack of activity, right? And I keep saying that I don't have a huge amount of activity. If you compare me to like Grant Cardone and Alex Hormozy and Patrick Bet David, I'm lazy. I don't want to work like them, yeah? And if I am doing more deals than you're doing, you need to step up your activity. When I say you're 1 in 1,000 chance of doing a 100% seller finance deal, you probably need to speak to about 2,000 business owners who are motivated. If you get lucky, and you manage to get, you speak to, for example, I don't know, 100 people, and they're all motivated. And by the way, 100 people that are motivated and they got good businesses. Most of the business out there are crap. That's why I say you have to speak to 2,000 motivated business sellers, because like at least 1,500 of them are not worth buying even if they gave it to you for free. They're crap, right? So now you've got 500 potential good businesses which are good for an acquisition, and you have to find out how motivated they are. So if they're going to do a 100% seller finance deal, let's say for example this is a thermometer of motivation, right? This is the thermometer of motivation. The seller needs to be at 100% motivation to even consider a 100% seller finance deal. So they have to be. So you have to speak to 500 business owners who are motivated, and out of them, maybe about 100 of them need to be, or not 100. That's probably going too far. So maybe about 20 of them need to be at 100% motivation to even consider doing a seller finance. Because then if you've got 20 people at 100% motivation to sell their business because they're dying, they need to move to another country tomorrow, they're going bankrupt tomorrow, or if they're going bankrupt tomorrow, in fact, they can't do a 100% seller finance deal, but they are extremely frail and they're old, maybe like 85, 90 years old or something. Or, this has been the case by the way, this is really good. Their lease has come to an end and they haven't find another seller. So the only thing that they can do is they close their business down. Yeah, tomorrow, next week, right? So they can close their business down. By the way, I came across this situation where a business seller, they were both really old, husband and wife, and their lease was coming to an end. I think it was like in 6 weeks. They had the business on the market for 6 years. By the way, I inquired about the business a few years ago, and they said I said your business is not worth what you're asking. In any case, they contacted me in the last 6 weeks of when their lease was ending. They said, we haven't found another buyer for the business. Are you still interested? So I had a relook at the business and I saw that there's no way that this business is going to be like meet our minimum criteria. It would have been too small of a profit. So we said, listen man, you got to close your business down. Okay, so what was I saying? I said, you spoke to 20 people who are 100% motivation, then one of them are probably going to do a seller finance deal for you. And they got good profitable business. Now, I never teach that you should go and buy a distressed business. But of course, if you've got a distressed business, then they're going to give it to you for £1. That's not even 100% seller finance, by the way. That's different because you're not paying anything for the business. Someone called me like 2-3 days ago. I can't remember exactly when it was. It was very recent, in the last few days. They told me about an example of, it's either Mike Ashley or someone, about that they bought, it was like Debenhams for £1, which was I think true. So Debenhams, one of these businesses they bought it for £1. Huge UK high street retailer, right? And they said, yeah, he bought this huge business for £1. Yeah, but it had pension debt of 150 million. Right? It had pension debt of 150 million. So he didn't buy the business for £1. Okay, technically he bought the business for £1, but then he had to plug in, and I can't remember whether he had to pay the full 150 million or whether it was a certain percentage of the 150 million, which was the pension debt. Let's say, for argument's sake, he only had to put down 10% to meet the regulator standards to continue running the business. He paid 15 million for the business. Now, I remember I said to the guy on the phone that no, he paid 150 million for the business, because what he did is that he plugged the pension debt. That's different. That's a business in distress. Now, the funny thing is that Debners wasn't running out of cash in that same way that it was a loss-making business from an operating trading perspective. But I don't know how they done it, but they weren't paying the pensions. Right? The employer amount of pension. So therefore, this huge debt got raised up on 150 million. So he didn't pay £1, he paid 15 million, 150 million for the business. And you don't want to do those kinds of deals. Unless you know, so the only time, take this now, the only time you should do a distressed business sale, a purchase, is if, for example, you know exactly how to fix the business, and you know how to do it quickly, and possibly even you've done it before. Because what you can do then is that you can get an asset for free, because you're not paying 100% seller finance, you're not doing anything, none of that. You're saying, hand me this business and I'll fix it. And then in those cases, by the way, you can make good money, because you fix the business and it only takes a short amount of time normally, and within a year to 18 months you can sell it for, even if you sold it for like 100 grand, you made 100 grand. Yeah? Even if you only sold it for 200,000, you made 200,000 over 2 years or 18 months or a year, whatever the time is. So that's a little bit different. So this is how you should structure your deals. Every single deal is different. Every single seller is different. You have to look at what the seller wants and also what you have. If you've got good retained earnings, let's say, for example, you've got good retained earnings, and I was going to talk about this, wasn't I? We're going to leave this. We're going to talk about this now, in fact. Sources of finance. Sources of, let's say, money. What it is, right? Money. That's what it is, money. Source of money, number one, and this is the easiest, you as a person. Right? Now, do I recommend you put 100% of your own personal money? No, if you can raise it, raise it. Number two, your business. Through retained capital. So, cash in the bank. Above working capital, of course, yeah? Number three, and this is from outside parties the easiest, lenders. And number four, investors. And why did I put it number five? Number five, sellers. In fact, that should be number one. So pretend I put sellers as number one. Yeah, pretend I put sellers as number one. You're a high net worth individual, you got $1 million that you need to invest tomorrow, you've got 10 million that you need to invest tomorrow, you've got 300,000 that you need to invest tomorrow, because it's sitting there making you nothing, put it into a business acquisition. Your business, you don't want to draw down on dividends and pay this huge tax bill. So the other way to create wealth for yourself is to funnel that money into a business acquisition. So your business, which is cash in the bank through retained earnings. Number three, lenders. Lenders are out there to give you money. Obviously, you need to pay interest rates. So three. Number four, investors. Private investors, institutional investors, individuals, funds. There's so many different types of investors out there. Angels, if you're in tech, VC. And of course, sellers themselves through deferred consideration and earnouts. So that's essentially a masterclass on deal structuring. If you want to find out more about business acquisitions, increasing enterprise value, and also exiting businesses, continue watching videos on the channel. Watch these videos which are pumping up here, and I will see you in the next video.